Hello guys, how are you? I hope you are doing well. So far, I have talked about Forex market, I have talked about demo account, I have talked about some basic terminologies behind the Forex market, as well as about pip and lot, okay? And the relationship between pip and lot sizes. But I have not talked about currency, okay? For example, what is currency pairs, for example, how the price of currencies are moving in the forex market, okay? If you are wondering that what factors move the currency price in the forex market, okay? Or what factors affect the currency value in the market. So don't worry, in this video I'm gonna take care of these two questions in details just in a second. So please at first make sure to like this video and subscribe my YouTube channel to get notifications from my newest video. Understanding the factors that affect a currency value is one of the essential or is a vital key that you need to know. Because when you trade in the forex market, you need to be able to understand what factors actually play a major role when you are trading in your live account. You need to understand that what factors affect the price of your base currency to move upward or downward, okay? So this knowledge will help you to get a wise and rational decision. There are many factors out there that affect the demand and the supply of a country's currency, okay? But the most basics of those factors that affect the value of a currency are interest rate, inflation, GDP or gross domestic product, CPI or consumer price index, okay? Trade, retail sales, economic release, okay? Political news and events, commodity price, market expectation, and industrial production. So these are the major factors that play a tangible role in the value of a currency. So I'm gonna analyze each of them in details just in a second. So thank you for your patience. If you have enjoyed from this video, please make sure to like the video, put comment in the comment section, or if you have any question or suggestion, also leave it in the comment section. And also make sure to subscribe this YouTube channel to get notifications from my newest video. I'm gonna publish a lot of informative videos about forex market as well as about some other useful topics weekly. Most basic factors that move a currency price. Here are some basic factors that move a currency price. First, interest rate, then GDP, industrial production, consumer price index, CPI, retail sales, economic release, political news and events, commodity price, inflation, trade, and market expectations. So these are the most basic factors that shift the value of a currency in the forex market. So these factors change the supply and the demand of a currency in the forex market. So I'm gonna talk about all of this one by one just in a second, okay? Interest rate. The interest rate set by the central bank is one of the most important factors in deciding the price movement of currency pairs. A high interest rate increases the attractiveness of a country's currency and also attracts forex investors toward buying. So this just means that when a country a higher interest rate than other country, so this expectation that the value of currency of that country will increase as well, because money of foreign investor will come to this country and buy that currency, okay? Because this currency gives more, interest rate than any other country. So in this case, the demand for this currency will increase. As a result, the value of this currency increase as well, okay? So when the demand for one currency increase, the value of that currency increase. The gross domestic product or GDP growth. This is also one of the vital factor case of appreciation and depreciation of a currency in the market. Okay, well, a high GDP growth signifies an increase in the total wealth of the country. This points towards the strengthening of the country's currency, and its value rises relative to the other foreign currencies. GDP represents the monetary value of all the finished goods and services produced in a country in a certain time period. In other words, the GDP measures a country's economic activity. This is an extremely important metric that you need to check before trading any currency pairs. Well, GDP shows the health of economy of a country. Okay, for example, when the GDP of a country increase, this means that that country is in a stronger position than other countries. Okay, so as a result, the expectation of people becomes positive toward that country, and they will buy goods and services from that country through their currency. So in this case, the price of their currency increase because the demand toward their currency increase. Okay, this is true in case of Japan, China, US, and Germany. Okay, next, industrial production. A high industrial growth in any country signifies a robust country economy. A country with robust economy, robust means huge. Okay? Robust economy encourages forex traders to invest in country forex currency. The word of industrialization is one of the common words in the world of economy. So this means that every country that is more industrialized, that country has a good economy, and people are willing to invest in that country, and as a result, the value of its currency increase. Okay, next one, consumer price index or CPI. The consumer price index or CPI is directly proportional to the price of goods and services in the country. If the CPI index is too high, above the central bank benchmark of CPI, there is high probability that the central bank is most likely to lower interest rate to bring down the rate of inflation and establish the growth rate for country's economy. And the next one, retail sales. A country's retail sales data gives an accurate picture of how people are spending and the health of its economy at the lowest level. Okay, so this means that the report of retail sales gives a fully comprehension from lowest level of a country. So this is one of the key factors in terms of evaluating the currency price, or in terms of fluctuating the currency price, or even in terms of the health of economy of a country. Next, economic release. The value of a currency is determined by the financial health of the country. The market reacts to economic reports released by governments or organizations because they give a clear insight on how a nation's economy performs and helps them compare one country's economic health against others. As a tip, economic calendar are the most useful tools when it comes to analyzing these factors. So economics release means that when a country release one news about economic health, this affect the value of its currency as well. Okay, so if a country for example announce that the employment rate is decreasing in that country, so this helps the value of its price to increase, and it conveys a positive message towards its people and foreign investors. As a result, people will become optimized toward its currency and economy. The next one, political news and events. Forex prices react sometimes in extreme ways to political news and events. The perfect example is how invasion of Russia caused the value of the ruble to decline precipitously in the past few years. Political news and unexpected events also have a major impact on the currency price. When a bad event happens in a country, for example, earthquake or drought, its currency value will decrease. So when there happen any good event or there be a good expectation toward some product has direct or indirect connection with the value of some currency. For example, the price of oil has indirect connection with Japanese yen and US dollars. Okay, so in this case, if the price of oil increase, this will damage to the value of Japanese yen and US dollar, because these two countries are the biggest importers of oil in the world. Vice versa, when the value of oil decrease, so the currency price of Japan's and US will appreciate against oil. Well, inflation is another factor that shift the value of a currency. So also it's important for you to remember that between 2 up to 4, even up to 5% inflation is normal. More than that is not good for economy. And the next one is trade. A country's trading relationship with the rest of the world can also affect its currency. Countries that export more than they import, known as a trade surplus, will typically have stronger currencies than those with trade deficit. If businesses outside the UK buy goods and services from the UK, for example, they will typically pay for them in pounds. The more a country exports, the higher the demand for its currency will be. So, as a result, the higher the value of its currency will become. And lastly, market expectation. Expectation of people toward market is also plays a major role. As you can see here, market expectation taking into account the above factors play a big part in exchange rate fluctuations. But unexpected interest rate cut or increase could have a more pronounced effect on exchange rate. So these are the most basic factors that play an important role in the forex market. Okay, so remember this.